you're on a desert island, and I can only give you 3 pieces of data or data sets that you can use to formulate a stock market outlook. What are the 3 things that you would most desperately want?
Median earnings growth. So that is actually the driver. I mean, ultimately, we always say, especially at Fidelity, stocks follow earnings.
The median stock in the S&P, you want to know the earnings growth for each stock, but the median across
level.
the market.
Median growth, yes.
Okay,
I mean, you could say cap-weighted growth, but median growth is actually a little bit more predictive, especially as it relates to the job market. So to the extent that the median company in corporate America is profitable, then they tend to hire. Right. So that's why like payrolls are a lagging indicator. Profits are a leading indicator.
So you care about the median versus the overall growth level, because the overall growth level could be like NVIDIA and Microsoft. And then that tells you nothing about the direction for all these other businesses.
Correct. It gives you a clearer perspective.
That's interesting. Have you ever heard that
the overall
before?
economy?
Never.
Oh, I'm going to put that out in my note this week.
Okay.
So stay tuned.
We like that. Give us number 2.
Credit spreads, which we just talked about. So credit spreads, sometimes when they're very wide, it's usually indicative of a bottom. Sometimes when they're very tight, it's usually indicative of a top.
Are they predictive though, or are they in the moment?
No, they're pretty predictive. So the quartiles, again, there's a statistical relationship. The tighter the credit spreads have been, the more likely the S&P is to go up over the next year. So you can give me trailing credit spreads, and I can say that there is a relationship here between that and future.
What credit spread data do you want? Do you want
high yield?
You want to know how tight or wide?
Yes.
Okay.
The differential.
Very interesting.
Oh wait, but probably only at the extremes, right? Because if they're very wide, you say, okay, stock's probably get killed. It's probably close to a bottom.
Yeah.
And if they're very tight, you say the economic backdrop is probably pretty good.
Yep.
What about if you're sort of in the middle?
Yeah, in the middle, there's like a relationship. So the tighter the credit spreads are, the more likely the stock market is to advance the year forward. Yes.
Number 3?
Yes. So number 1 is median earnings. Number 2 is credit spreads. And number 3 would probably be valuation spreads, which is another quantity expression if you're in the market, which has very little relationship to valuations.
Wait. You got to give us more on that.
Right.
Valuation spreads of what?
So it's just the difference between cheap and expensive stocks, and the names change every single cycle, but you usually have this blowout in spreads, which is an expression of fear. When investors sell anything they think is risky, they buy anything they think is safe, and they have this gap. If you are willing to,
bigger gap means more fear. And that's good or bad?
That's good for contrarian investing, because the more fear there is, the more likely it is that you've already priced in the fear.
So you actually want to see that?
Yes.
Okay.
So that's what I would always want, because
relative
if you see
to
that
a year
very
earlier,
wide.
like what are you measuring it against?
Relative to history.
Relative to history.
Yep.
Where are we today on something like this?
On a median basis. So when you look at sort of the equal weighted S&P 500, we're still in the top quartile, meaning that there is still a lot of fear.
So good.
Yes.